Let's start the class. So now we were discussing about the unsystematic risk. So what do you mean by unsystematic risk? This is the risk which is just associated with one single company. Okay, if any fraud happens in that company, any like strike or any halt in the production happens in a company, the company's investors, their investment is at risk. That means the company can be shut. The company can shut down its operations because of constant strikes and like halt in the production, and that could impact investors' investment in a company. So that is only like what we say restricted. That is only restricted towards a one single company. Okay, that means if you have invested in XYZ company and all these events like strikes and halts in production, anything, any such kind of events happen in a company, so companies operations get disrupted, and then the investors, they can lose their money if the company is on the verge of shutdown. Fine. So how come you can reduce or minimize your unsystematic risk by diversification? That means instead of investing in XYZ, you invest in ABC, DEF, various other companies, so that if this doesn't perform well, this would at least give you returns. Systematic risk is the risk of market. That means market, when I speak about market, there are various companies which are in market. If I take index, BSE index, Sensex, I mean to say Sensex, there are 30 companies in BSE. The Nifty, National Stock Exchange, there are 50 companies in Nifty. So if I buy the stocks of BSE index or Nifty index, then what happens? All these companies, what I'm speaking right now, like these 50 companies would be a part of Nifty, 30 companies would be a part of Sensex. So I'm speaking that you can buy a index stock, which would be, the stock would be based upon the net asset value of the entire of the entire Sensex, of the entire like the, suppose if I speak to you that you have to buy the stock of Bombay Stock Exchange, like, or BSE index stock you need to buy. That would be nothing but a combination of all 30 companies all together combined. That the stock would be a combination of all 30 companies, like what we say. See, suppose if you invest in ABC company, for instance, you get profits from ABC company. So if I speak about index is average profits of all these 30 company stocks. Okay, let's say this is ABC company. This is giving you 14% returns. If I say BSE index or Sensex, these are 30 companies. So every company would give you some return. Some company would give 8%, some company would give you 9%, some company would give you 10%, some company would give you 13%. So on an average, if I calculate, I'm getting 10% returns from BSE index. That means this is more safer than this company. Why? Because BSE index is a combination of all 30 companies, and your investment is nothing but, it gets diversified in this BSE. If you invest your money in this BSE index, so it gets diversified. That means if you invest 10,000, your 10,000 would go directly into this company. But if you invest in this, your 10,000 would be divided amongst 30 companies. So if any of the 5 companies are not performing well, 25 would perform well, and you would get you would get average returns of 10%. Or you can invest in mutual funds even. Mutual funds are also one of the ways of one of the kinds of diversified investment options available in the market, whereby they make a fund with a combination of various company stocks or bonds, and there also diversification is happening. If any of the company is not performing well, or any 2 companies are not performing well, other companies in the fund would perform well, and you could still get returns. Okay, so that is the that is what is the like the explanation for the diversified investment. Now, what is this systematic risk? See, systematic risk is the only risk which is prevailing, okay, which an investor really should be scared about or should care about. Why? Because here unsystematic risk you can diversify, you can minimize. Unsystematic risk or undiversified risk you can minimize through diversification, and you're not losing any money in this by kind of following this strategy. I mean to say, if you have invested your entire money in XYZ, of course, there is a chance that if this company goes into losses, you'll lose your money. So what you did to minimize that, to minimize your losses, that means if you're losing the entire money, okay, then you're not left over with any returns. That means you're in losses. But if you diversify your investments and you invest in more other two companies, if this is not doing well, then these two would at least give returns. But what if you have invested in the BSE index and the market crashes? There is a crash in the stock market. When the stock market crash, all the companies which are a participant of the stock market or BSE index, all will underperform. That means investors would lose their money at any cost. So here you cannot further diversify because the portfolio is already diversified. Okay. So when there is a market crash, every investor would lose, and diversification, you cannot minimize the losses in this case because you cannot further diversify. You have only the last option available is like investing in all these 30 companies completely. But here you can diversify and you can minimize your losses. So the final conclusion is systematic risk is the only risk because this cannot be reduced or minimized through diversification. Okay, this is the only risk what an investor should worry about. Unsystematic risk can be minimized or reduced through diversification. Market risk, I can say systematic risk is also called market risk. Industry risk, suppose you're investing in a particular industry. If I have to speak about, suppose you have invested heavily on hospitality industry, that is hotels and all, like JW Marriott, you have like Taj Group. There are various hotels available in India, and international brands also are there. Accor Hotel Groups, Novotel and all, they come under this. So if you have invested your money in this SOTC, tours and travels, so all these kind of companies which are related to travels, tours, hospitality, then during COVID-19, all these companies, they did not perform well, and investors lost their money badly because these companies didn't perform well. They couldn't do anything, but because uh, like uh, the scenario was of such kind, things were not going in their favor because people were reluctant to travel because they were scared of this COVID-19 virus. Correct. So the hospitality industry, it performed very badly, because of which the investors lost a lot of money. So that comes under industry risk. So if you invest in only one of the industries or specific industry, there could be a problem whereby you can lose your entire money. So it is better to diversify in industries. Okay. So if suppose if you have invested in the hospitality industry, better you can go for banking, or better you can also opt for software. So suppose I have taken 3 stocks of hospitality industry, 2 stocks of banking, 5 stocks of software. Still, I can expect good returns. Why? Because I have diversified in my investment in various industries. Relationship between risk and return: the more the risk you take, the more the returns you should expect. That is what we have already discussed. Okay. So this EAPM model I have explained very clearly when we were doing investment decisions, and I explained you I have given the example of bank and company, stock market and company. Then I told that what returns you should expect from this carry company which you are investing into. So that the answer for that question we can get from the CAPM model that we have already discussed. So let's today go with the questions and understand. Okay, just a second, Zarina. Zarina, you have an idea about beta also, no? Hello? Hello?
Yes, sir. Yes, sir.
You have, na? Okay, then it's easy. Then we can directly do the questions. I've already explained about beta also. So this is the formula for CAPM. I've given a very good explanation regarding this. Please do this question. I'm waiting. You're doing now, Zarina? Hello?
Yes. Hello. Yeah, I'm on
Okay.
it, sir.
Okay. So what does it say? Your risk-free rate is this. This is your, just a second. So this is your risk-free rate, and this is your beta, this is your market return, this is your RFR, risk-free rate. So this is your expected return from that particular investment. Okay, this investment is less risky than market. Why? Because beta is less than 1. Then we will discuss about the security market line. Security market line is nothing but this is the line which gives you the combination of risk and return. For what risk, how much returns you should get. That is what this security market line is all about. We will see the security market line. Line, this security market line is nothing but this is the line of CAPM. Okay, let's see how. So you can see here beta return, risk return, risk return, risk return, risk return. For this risk you are getting this return. For this. For this risk you are getting this return. For this risk you are getting this return. We can plot a graph of this. That means we can plot a graph of risk and return. We will take risk in the x-axis, we will take the return on y-axis, and you can see the line which is forming here is called a security market line. This line is nothing but line of CAPM equation, because CAPM equation is like a linear equation. A linear equation is nothing but one which gives you the perfect combination of risk and return. That means for this risk that is no risk at all. This is called risk-free rate also. There is this return you're getting. Okay, there is this return you're getting for the risk of the for this risk. When you have increased your risk from 0 to 0.5, the returns you're getting are this. When you increase your risk to further 0.5%, 0.5, that is 0.50, your return is this. For again further increase in 0.5, return is this. Again a further increase in 0.5, that means you will plot it here. The return is this. Okay. So what is happening when the risk is increasing, the return is also increasing. Okay. Just have a look through this graph. We'll go further. Okay, so let's go ahead. As you can see, this is a straight line. It's a line which has which we can write in this way: y is equal to a plus bx, or like mx plus c. This is also called as slope intercept form, which you know from your school days. You know this kind of equation you have done. This is the slope, this is the y intercept. Okay, and slope is nothing but change in y axis by change in x axis. So you can clearly see change in y axis. So from here to here, if we go, that is 0.5 is the change in change in x axis by change in y axis. Just a second. Fine, change in y axis, we can take this in the numerator. Change in x axis, you can see from here to here. Then you can see the change here, what you're getting. Okay, I think it is like 1.5. Okay, so that is m, the slope. And here this like if I say y is equal to mx plus c, let's say, here y's value depends upon x value. So x is nothing but independent variable, and y is dependent variable. What do you mean by this? See, if I say about demand and price, your demand definitely depends upon price. So price is an independent variable. So x can be termed as price, and y is a dependent variable. Y can be termed as demand. Okay, because as you increase the price, the demand decreases. As you decrease the price, the demand increases. So demand is always dependent on price. So y, that is dependent variable, demand can be can be kind of indicated with y, and price, which is an independent variable, can be indicated by x here. Okay. Now, so here what they have explained is 7.5 minus 4.0 change in y axis. Somewhere here 7.5 minus, somewhere here change in y axis, then here to here they have taken by change in x axis, that is 1.5 minus 1. Okay, 2 and 1 they have taken. So graph is not clear actually. 2 and 1. Okay, because this and this, let's say this one, and let's say this one. Okay. So change in y axis is between 7 and 4, 7, I think 7 and 4, and change in x axis is between 2 and 1. So 7.5 and 4. Okay, 7.5 it seems. Graph is not clear, but we can. Okay, this is 7.5 according to that. So change in y axis by change in x axis is the slope. So that you can do for any combination. Okay. Always the slope is constant. Okay. So y is equal to a plus bx. There are, or y is equal to mx plus c. Anything is all right. There are two constant things. One is slope and one is y-intercept. This and this won't change. Only this would change when x would change. Okay, but m and c are always constant in this. Can you do this question, Zarina? I'm just waiting.
Done, sir. Hello.
So as you can see, expected rate of return to the market is this. This is the market return. RFR, risk-free rate, is this. Required rate of return for various stocks with different betas estimated as follows using the CAPM. So what is happening? Stock A's beta is 0.5. They are asking you if the beta is 0.5. That means they have given you the market rate, market return, have given the RFR, risk-free rate. So risk-free rate plus beta is given into market return minus risk-free
No,
rate.
market
Give
minus
you
directly the price.
2.25%. Hello?
Yes, sir.
Yeah. And when you increase your beta from 0.5 to 1, you see your returns are increasing. Why? Because risk is increasing. Again, further increase of beta, when the risk is increasing, that is beta, the return is also increasing. And you can see here, this is always constant, risk-free rate. Okay? And market return is also constant. Only the betas are changing. Fine? And you can see risk increases, returns increases. Why? Because the more the returns you should expect. You're following, Zarina?
Yes, sir.
Yeah, just a second. Okay. You can just have a look through that and I'll move forward. Okay, let's move forward.
Thank you.
So required return, expected return, and stock price. So required return is what you get to know from the CAPM equation. Okay. Expected return is like what you really expect. Okay. So what actually from the market you could get. That's what is expected return all about. So you would always try to compare your required rate of return with expected rate of return. See, required is what as per the CAPM. So let us read out some points. After the required rate of return on a particular security has been estimated by the means of CAPM. So CAPM will tell you what should be your required rate of return. That required rate of return can be used to calculate the intrinsic value or fair value of a share of stock. Yes. So what you can do is you can take your CAPM's required rate of, you can take the required rate of return what you got from CAPM equation as a cost of equity. So you know, like we have already discussed that in the chapter, uh, like uh, like how to find out the stock value. So you can find out your stock value in this way. Suppose company is giving annual dividend of $10. Invest and suppose like if I write here the stock value, intrinsic value of stock is, I'll tell you what that is. Suppose it is $100. So the on investment of $100 you are getting $10 as dividend. So what is your return? 10%, correct? That is called as your investors required rate of return. Okay. So now I'll interchange the equation. So suppose this is what? This is dividend. This is stock price. For stock price, I will write P. Okay. Let's say P naught. This is KE, the required rate of return. Now what we can do is we can interchange. Excuse me. So here, like, I'll just put something. So this is like $10 is your dividend, $100 is your share price. So dividend by share price is nothing but you get returns. Like here you're getting 10%, and that is your KE. KE is nothing but, we can say this KE, we can give two names to this: cost of equity. As you know, we have already discussed about this in our chapter. Cost of equity for the company, but for investors it is required rate of return, which you find out with the help of CAPM equation. Okay. Now let's interchange the things. What I'll do is $10 is my dividends. I'll just bring it here and take that there. Divide by 10% will again give you stock price. Okay. That's the same thing. You can just have a look through this. I'll move forward. Okay. Let's move. So we were discussing something in that paragraph. So please try to understand. See, intrinsic value of a stock is nothing but the expected value of a stock. What you really expect the stock value should be. So you can find out the stock value in this way, as we have discussed right now. This particular formula, in this formula, what has happened is you have like you have an expectation. See, please, my points are very clear. My points are what points I'm saying. You have to put you have to stress on that. It is not the dividend what you're really getting, it is the expected dividend. So expected dividend is $10. Required rate of return, you can get that like from the CAPM equation, and that is the estimate. Again, this is expected or estimated. That means estimate or expect, or an estimate what you have made, or you are expecting that you should get that particular amount as dividend. This is what your required rate of return is, which you have calculated already before investing in the investment option. So that is again, like we have discussed, it is 10%. That is giving us the stock price. That is the intrinsic value of a stock. That means expected value of a stock. Okay, or the fair market value of the stock according to us. What the fair market should be. Okay, fair market value of the stock should be. That's what we have just calculated. Now, the intrinsic value of a share of stock is what its market price should be. See, I'm saying clearly it should be. But do you think it really will be? Please answer my question. The stock price should be
No,
$100, but do you think that stock price will be $100?
no, it can change.
It can change. That's
It
what.
can change,
So
sir.
yeah, good. So based only on its expected future cash flows in the form of dividends, we have calculated the intrinsic value. Now, the actual market price of stock and its expected future dividends can be used to calculate expected rate of return on the stock for comparison with its required rate of return or estimated rate of return. So as I have discussed with you right now. So see, first you will estimate, then you will see what is the actual. So the actual market price is nothing but in reality what the market price is, and its expected future dividends that we can take and find out the expected return, and we can compare with the required rate of return. Okay. So calculation of intrinsic value. So all this will be covering in the future chapters in detail. So let's right now move further. So the intrinsic value. So what is the intrinsic value? Intrinsic value of a stock is the present value of future cash flows in the form of expected future dividends. How are we getting this present value of future cash flows? Or future cash flows are nothing but the dividends, expected dividends. And this we are discounting with cost of equity to get the present value. Discounted at the investor's required rate of return. If the future cash flows are all the same amount, they are discounted as a perpetual annuity. That means if you expect that the future cash flows are going to be like some amount, suppose $10 for lifelong, then you take perpetual annuity to find out the stock value. Okay. And if there is any growth, suppose whatever dividends you are getting, we generally expect investors to reinvest that again, and there comes the growth factor. So if again we expect there will be a growth in that also we should include in our calculation, and we'll see what methods we can use to do that in the coming pages. So please calculate this. I'm waiting.
Done, sir. Hello.
Zarak, just give me
Hello.
a second. So please carry on. I'm coming. Finished, Zarina?
Yes, sir. Done.
Okay. You're doing
Hello.
this?
Done, sir. Done.
Okay.
Done.
Now let's discuss. This is the intrinsic value of the stock. This is the dividends. This is the cost of equity required. That is required rate of return from the CAPM equation. So, Zarina, like, can we continue this again in the evening? Hello.
Yes,
Hello.
sir. Hello.
Yeah.
Okay, sir.
Zarina, can we continue this class in the evening?
Okay.
Yeah, I had free time, so
Yes,
I thought
sir.
of taking the session. Evening, you be ready for the class. I will finish this chapter and I'll wind up this one. Okay, today evening.
Okay, sir.
Probably by 8. 8:30 p.m. or so, we'll start the class today. I'll wind up this chapter.
Okay.
Okay. Almost like only
Yeah.
some pages are there. We'll wind up. Yeah. Thank you.